The Canadian cannabis has had a rough start, with producers being surprisingly bad at growing their product, making even basic mistakes like overfeeding their plants and then overcharging for their product. So despite the black market lacking consistency, it remained the better alternative to legal bud for some time, which led to most of these companies taking huge losses. But many have improved their growing methods, and some small, unknown players have become profitable, while the big ones, who felt the need for budget constraints only after burning through their billions of dollars, are still losing, but are at least producing high-quality flower that is more consistent in the black market and roughly the same price, and are therefore growing. But not all are going to make it. Entourage's products may or may not have improved in recent years. I hadn't bothered to check, as it wouldn't matter if they were growing the best product at the best price, as over 70% of their revenue is going to servicing their debt, which is huge and high interest. Second to last place on my list is Sundial, as their product brands are either low quality or overpriced, but their retail brands are much stronger, and could be stronger still if they were to shed their production and focus on what their customers wanted, rather than what they want to sell them. I recently made a video on them in which I reviewed their numbers, and they would be profitable if they were retail only, possibly very profitable. But as long as they insist on producing their own brands, I believe they will struggle to turn a profit and keep earning their cash, which they do have a decent amount of. Organigram had a good run starting 2 or 3 years ago, as they were selling what was for the time decent quality at a reasonable price. Their revenue trajectory tells the story of this market, with value producers taking share through their low bulk prices on reasonable product when much of the market was offering high prices on questionable quality. But competition within that category has increased substantially, making it difficult to earn anything. They lost about $60 million last year, by one simple metric, and have about that much in cash and receivables, which is much less than they had 2 years ago. And if they don't start selling more innovative and high-margin products, the big investment they just got may dwindle as quickly as one of their big bags. Village Farms is in a similar boat. A few years ago, their products were the cheapest, and I felt they were among the worst. I tried them a few months ago, and their product quality was a fair bit better, so I understand why their popularity has persisted as long as it has, given their low price. But they are now up against products which are cheaper and better, in my opinion. So while they're close to break even, I believe they'll lose market share. Another similar company is Cronos, whose margin is a bit low and operating costs are high, but they won't be running out of money anytime soon, as they have over $800 million in liquid assets. While I can't say there isn't a certain amount of value to their brand, I'm just not excited about them. Canopy Growth had a very rough start until they acquired Supreme Cannabis, who possessed significant skill at producing these products. Before that, Canopy's Tweed brand was known for producing expensive garbage. But it appears as though Canopy got their new growers to teach their old growers a few tricks, and the difference has been dramatic. A few years ago, if you were to ask a bud tender what their least popular brands were, they'd likely mention Tweed. Now it may be listed amongst their most popular. They offer fairly high quality given the price, especially in bulk, considering that they undercut most of the value brands that I mentioned earlier. In fact, I'd say Tweed has been most responsible for the decline of the original value brands. I believe they have a lot of potential, but their numbers are terrible. Over the past few years, they've had negative margin as often as they've had positive margin, and it's usually between 0 and 5% either way. But their BioSteel brand was the biggest drag there, which they recently sold, so it will be interesting to see how they improve in that department. They're a long way from being profitable, but it will be interesting to watch. Tilray is a very similar story, in that they started off selling low-quality, high-priced product, as well as cheap, even lower quality, but they eventually made a turnaround and are now selling fairly high quality at a low price. However, Tilray's improvement has been so recent that you can go back and watch videos I uploaded last summer in which I say they're not a good company. But this fall I started hearing they were selling much fresher flower with higher percentages, and these rumors proved to be true, and the improvement is so drastic that they, in my opinion, went from downward spiral to high hopes. Their margin is much better than any of the previously mentioned companies, but they're still losing a lot of money. However, bud tenders seem more likely to recommend their brands these days, and the ones who generally give me the best information tell me that customers have noticed the improvement. They're definitely a few quarters away from being profitable, but I think they can get there, which I never thought I'd say just a few months ago. Aurora also had a rough start, but enough cash to survive. They're still losing a fair bit of money, but they have a strong brand that sells flower at a good price. And, much more importantly, and recently, they started a brand that sells infused pre-rolls at 50%. Which no one else has managed to offer in a product that still burns despite these levels of concentrate, and they're the fastest selling item on the market right now, based on my observations at least. I recently made a video about them, but the short version is that this product is so strong that I want to put Aurora higher on this list, but the top 4 are profitable microcaps that nobody seems to know about. Most of the previously mentioned companies were well funded and had time to make significant changes, or just coast for longer than the ones who have already gone broke. But a few companies didn't have that luxury and managed to survive by selling products that people enjoy while operating on a tight budget. Cannabis has always had a focus on concentrates, and now mainly sell vapes and infused pre-rolls, the latter product being a difficult one to produce. Infused pre-rolls first entered the market about 2 or 3 years ago, and they have become very popular since. Cannabis was one of the first to produce them, and it helped them turn a profit as they were selling out at high prices. But other producers are now undercutting them, and I feel as though they are too expensive versus too many competitors to be excited about them. Their revenue peaked in the quarter that ended January of last year, and especially with Aurora's new product being well priced, I doubt they'll fully recover unless they make some changes. Rubicon has managed to turn a profit by being very good in the ultra-competitive flower market, with one of their brands selling at the highest prices in the industry, and another selling what is still very well-grown flower for a couple of price tiers lower, which is still more expensive than most of the brands we've discussed so far. They had a great run about a year ago when they grew a few new strains that people liked. But customers in this industry like the next new thing, and they may be trying to rely too much on what has already worked, especially given that they refer to one as being a hero strain. They also haven't lowered their prices in a while, despite many competitors having done so, and may now be in a situation where their current products are overpriced and old news, and they sit on the shelf as consumers buy the latest strain at lower prices, a trend their earnings bear out. They have another brand that sells bulk at a much more reasonable price, while still being very well grown. When their best strains were new, they were saying they couldn't keep up with demand, so their discount brand was mostly unavailable. But I have noticed it on shelves again, another indication that their sales of small quantity at high prices are drying up, and they need to liquidate some product. But they have also discussed expanding capacity using contract growers, so the reappearance of their very popular discount brand may be due to both factors. Either way, they can definitely come up with new strains, and they seem to have just gotten started in the infused pre-rolls and vapes, so they could continue to do well despite my concerns. Cannabis Biotech is based in Quebec and is fairly new to my area. Their flower is very well grown and reasonably priced, and reports indicate that customers appreciate them for it. I don't believe they're selling infused pre-rolls yet, but their flower quality per dollar is high enough for them to be profitable and growing. But none of these companies are making as much as the number one on the list, which of course is Decibel, who I first noticed about 3 years ago, when they were one of, if not the first in Canada to offer flower at 30+%, which sold very quickly at the highest price point. But others in the market caught up in that category, and Decibel invested in concentrates, which was an underserved market at the time. They soon began working on infusing pre-rolls, and ended up crafting what has been, for more than a year, the most popular product on the market. Concentrates are basically a very viscous liquid, and infusing flower with it in such a way that it burns well can be difficult. And Decibel's ability to offer such a product has given them more brand power than anyone else in the industry, in my opinion. They're also making more money than anyone, despite a valuation below $60 million Canadian, which seems quite cheap even at current levels of profitability. Levels which allow them to improve their balance sheet and, assuming current earnings are simply flat, say around $5 million a quarter, will allow them to buy back shares in the not-too-distant future, as they are not planning major capital spending projects. If earnings begin to accelerate again, which they may given that they're just entering European markets, they could have a strong balance sheet and buyback program quite soon, despite their valuation indicating a strong risk of complete failure. None of this is financial advice, of course, but what gives me the most confidence in them is their ability to innovate. They are constantly introducing new products and strains, which is a must in this industry, as it is what the consumer demands.